It's earnings season on Wall Street, and the numbers are staggering. Major U.S. banks like J.P. Morgan, Goldman Sachs, and Morgan Stanley have just reported record profits. Their earnings are up double digits year over year, investment banking fees are soaring again, and trading desks are pulling in billions. For investors, it looks like a golden age has returned. But behind those big numbers, analysts are starting to ask, is this growth real and sustainable, or are the markets overheating? Let's break this down. After a year of high interest rates and economic uncertainty, many expected 2025 to be a cooling period. But instead, Wall Street is booming. J.P. Morgan posted over $14 billion in profit last quarter, its best showing in nearly a decade. Goldman Sachs surprised analysts with huge trading gains, especially in equities and commodities. Even regional players like Fifth Third Bancorp and PNC have seen profits climb as lending margins widened. So what's driving this massive surge? First, interest rate spreads have worked in favor of big banks. While the Federal Reserve hasn't fully cut rates yet, the prolonged period of high borrowing costs means banks are making more on loans than they're paying out in deposits. Consumers and businesses continue to borrow, not recklessly but steadily, and that's generating consistent interest income. Second, trading activity is back in full swing. The volatility caused by AI-driven stock valuations, new tariffs on Chinese goods, and speculation about the Fed's next move has created a playground for Wall Street traders. When the markets swing, traders profit. Third, corporate deal-making has exploded again. Mergers and acquisitions are roaring back after a quiet 2023 to 2024 period. The biggest headlines, from Fifth Third's $10.9 billion Comerica deal to renewed private equity activity in tech and healthcare, have reignited investment banking fees. These high-value deals are injecting life back into the financial sector. But there's another less visible driver, AI. Yes, artificial intelligence is transforming Wall Street itself. Banks are using machine learning for everything from risk modeling and fraud detection to algorithmic trading. AI allows trading desks to process massive datasets faster than ever before. Goldman Sachs recently revealed that AI-assisted models are now making up a significant portion of its short-term trading decisions. That edge is producing better returns, but also raising questions about stability. Because when algorithms move markets faster than humans can react, volatility can amplify. And that's where the risk of overheating starts to emerge. Let's talk about that risk. The S&P 500 has climbed more than 20% since the start of the year. Tech-heavy stocks like Nvidia, Microsoft, and Amazon are leading the charge. But even financials, usually a more conservative sector, are trading at near-record valuations. Historically, when profits rise faster than productivity or wage growth, the economy eventually slows down to catch up. It's the classic too much money chasing too few assets scenario. Economists at the IMF recently issued a warning about asset bubbles forming in both equities and bonds. They highlighted how market concentration, meaning a handful of companies driving the majority of market gains, could amplify corrections when sentiment shifts. And Wall Street knows it. Jamie Dimon, CEO of J.P. Morgan, recently cautioned investors not to get complacent. He said markets are priced for perfection, meaning they're assuming everything goes right. Smooth rate cuts, no recession, steady inflation, and strong earnings growth. But if even one of those assumptions cracks, valuations could tumble. Another red flag? Corporate debt is rising again. Companies are issuing bonds at record levels, betting on rate cuts in the coming months. But if inflation ticks up or the Fed delays easing, those debt costs could backfire. Remember 2007? The feeling of we've engineered the perfect system was everywhere, until it wasn't. Still, this moment isn't identical to 2007. Banks are better capitalized, stress-tested, and more diversified. The difference now is technological, not structural. AI has changed the speed and scale of financial markets. Traders can act on news in milliseconds, and sentiment shifts faster than ever before. For the average investor or small business owner, this dynamic matters, Because what happens on Wall Street eventually ripples into Main Street. Overheated markets often mean higher volatility in credit, funding, and consumer confidence. When stocks surge beyond fundamentals, corrections follow. And those corrections can tighten lending, slow hiring, and spook spending. So the big question is, are we seeing real, fundamental growth or financial excess? The answer might be somewhere in between. Corporate earnings are genuinely improving, especially in energy, defense, and AI infrastructure. But valuations are stretching far beyond historical norms. Price-to-earnings ratios for many major firms are at their highest in 2 decades. At the same time, consumer credit card debt has hit record highs, and delinquencies are quietly ticking upward. That's the paradox of this moment. Profits are up, but so is risk. Now, let's look at the Fed's role. The Federal Reserve is under intense pressure to start cutting rates. Inflation has cooled from its peaks but not fully stabilized. Chair Jerome Powell has signaled 2 potential cuts by year-end, but Wall Street has already priced in more. If those cuts don't materialize, the market could react sharply. This delicate balancing act between maintaining growth and preventing bubbles is what will define the next phase of the U.S. economy. If the Fed cuts too fast, inflation could reignite. If it waits too long, asset prices might deflate on their own. So what should businesses and investors be doing now? First, resist the temptation to chase the rally blindly. This is a moment for disciplined strategy, not euphoria. Focus on sectors with real earnings power: manufacturing, energy infrastructure, defense, and AI logistics. Second, diversify. Concentration risk is the biggest unseen danger right now. Too many portfolios are tied to the same handful of tech and financial stocks. And third, prepare for volatility. When profits run this hot, corrections aren't just possible, they're inevitable. Wall Street's profit surge is impressive, no doubt. It's a sign of resilience, innovation, and capital strength. But history reminds us that every boom comes with its own echo. The key question isn't whether the markets are winning, it's whether they're running too fast for the real economy to keep up. Because when that gap widens, the heat we feel on Wall Street eventually spreads everywhere else. And the longer it burns, the harder the cool down hits.